Welcome back, everyone, to Let's Talk Business Live. This is the first time that we will do it on LinkedIn and YouTube Live. So sorry, tonight I won't be able to interact directly with you in the chat, but my team will. So maybe if you have more personal question, do not hesitate to put the question into the chat and I will answer as soon as I can. This is Let's Talk Business Special Family Office. I will introduce myself. I am Hedi Mesme, CEO at Limitless Capital in Dubai. We are an incubator and accelerator and currently building $100 million funds to invest in startup through a de-risked model. We are working closely with family offices, and the more we spend time with them, the more we saw a lot of fear and a lack of understanding on how the new economy and the new opportunities can work for them. They were used to use this magic 60 portfolio that crossed all generations for the past 50 years for family offices. I thought it was very interesting. So I am also advising personally some family offices in Europe and some ultra high net worth individual for the integration of new technology and Web3 infrastructure in their portfolio and investment plan. So I think that was very important to make that live tonight because there is a lot of So tonight I will cover 6 questions, the most frequently asked to me when I work with family offices. And the more I gathered those feedback, the more I said, I think I really need to push forward and to try to clarify a lot of things regarding how I see the strategy and what would be the best strategy right now for family offices to structure their portfolio. You have 50, 100 or 500 million under management and your banker calls you every quarter. Your returns are fine. They say fine. But fine is not really a strategy, as you know. Fine is how generational wealth disappear in 2 generations. Tonight, I am answering the questions your banker hopes you never ask. We can see that the fine is how generational wealth disappear into generation. So I will now cover 6 topics to demystify a bit what family offices are generally thinking. Obviously, I am not talking, if we have some family offices that are listening tonight, I'm not talking to you directly. This is more a general point of view, but I would be more than happy if you want to contact me in private to clarify the question you may have on what I am saying, or maybe you will have some question. I would be happy to help you if you have anything related to this topic. Before answering the question, I really want to say that it's the first time we will be live on LinkedIn and YouTube, and we plan to do at least once a month an interview with one family office based in Dubai, UAE, or maybe any place in the world that are integrating new technologies in their portfolio and their investment infrastructure. And the idea would be to have a live Q&A with the audience that will come for the event. So I think now in the era of AI and all the avatars that will come on the net, I think it's very important to stick to the live because this is where the AI won't be able to replace you for now. So I think betting on live and interacting with an audience online live is very important and very interesting to connect and use the technology to connect with all people that may be interested on this topic. So I will answer to the first question that I am receiving from family office, especially from portfolio manager. They come to me on the 60-40 question. The usual question is, so I rephrase the question. I have put the question just to help me to develop the narrative. But the question is, they tell me regularly, Hedi, my advisor keeps telling me the 60-40 portfolio is back. Bonds are yielding again. Why should I change anything? As we know, the family offices, their main mission for the past 20, 30 years was preserving the capital before trying to make it, because there was the inflation, there was a lot of things, and they wanted to keep all the money for the next generation to come. The 60-40 return did minus 16% in 2022. bonds and equities fell together for the first time in 40 years. That's not a blip. That's a structural break. In fact, 2022 was the only year since 1979, 1980, where both US stocks and US bonds posted negative returns simultaneously. That correlation failure is entire argument. This is the entire argument, because we were really used for 40 years to have that kind of security in our portfolio, going 60% on public equity, 40% on bonds to generate yield and cash flow. That was the good balance. That was perfect. But nowadays, we have an inflation above 3% permanently, and that erodes bond real returns. We are not going back to 2% inflation. That era is structurally over. I don't think that we will have inflation going down below 3%, at least for the next 5 years. So I think family offices and wealth managers should anticipate that and start to restructure the approach. What we are seeing is the institutions that are managing 100 billion and plus, like Yale, Norway's government pension fund, Eddy here in the UAE, they allocate less than 10% to traditional bonds nowadays. Yale's 2024 endowment report shows fixed income at under 5%. They know something your banker doesn't, for sure. Your banker gets paid to sell you products. He doesn't get paid to tell you the product is broken. And this is a major thing, because if you are a private banker, you know that the system is not as good as it was because we need to change structurally. He won't tell you that because he's here to sell you something. He's here to sell you the access to the bonds, the access to the public market, and all of their services. Yale has under 5% in bonds, and your private banker has you at 40%. Ask yourself who is right. I think you just need to follow the smart money to understand what is really happening. So first of all, the 60-40 question is a very tough thing, especially for the medium and small size family offices, because they are still in this position of preserving the capital. And preserving the capital is not a good strategy right now, because even if you want to try to preserve the capital through bonds or things like that, the inflation is eating you. And usually in few decades, we can see a significant decline in value of the portfolio. So that leads us to a second question that I have a lot. It's the alternative assets. Because if we want to get out from the traditional 60-40, we need to think about integrating alternative assets. So what kind of alternative assets family offices should get? The question that I receive mainly on the alternative assets is, everyone talks about alternatives, private equity, real estate, hedge funds, but aren't these just riskier? I don't want to lose capital. Same position, family offices, they don't want to lose capital. So there is one thing, is like the risk is not the same as volatility. Your stock portfolio can move 20% in a year. That's volatility. A private equity stake in a profitable company growing like 50% per year, that's risk managed compounding. This is a big difference. The real risk is concentration. The 60-40 is over. It's very risky to keep that in the old safe asset. The real risk is concentration. 60% in public equities means you are exposed to sentiment, to algorithm, to macro noise, to Donald Trump, and his tweets. We are seeing now when you have the Trump family that is organizing, prior making an announcement to buy or sell any kind of stocks and making the market moving. I think putting everything in the public equities is very risky nowadays in the era of social network and the era of X, Twitter. So the alternatives break that correlation of public equities and these ties with the sentiment and the algorithm and macro noise. Family offices are here to preserve and develop wealth over the next 10 decades. So what is the strategy for the next generation and what is the strategy for the next 5 generations? And diversifying is nowadays mandatory for family offices. For example, real estate in Dubai, tokenized assets, private equity. Those are not risky. They are illiquid. Illiquidity is not the same as risk. You get paid a premium for it. It's very different. The question isn't, are alternatives risky? The question is, can I afford not to be in them when inflation is running above 3%? This is my question. The question is like, can I afford not to be in the alternative assets anymore? I don't think the family offices can have that luxury of not being in alternative assets. Your banker calls alternative risky. Yale, they have 77% of their portfolio in alternative assets. You can check it. It was a report from 2024. So one of them has 41 billion in alternative assets. And on the other end, you have your private banker. What does they have? Your money. He wants to keep you in the same structure. He doesn't want to see you moving and taking more risk and exploring new way to invest your money. So if we speak about alternative assets, nowadays it's very complicated to speak about alternative assets without speaking about Web3 and the crypto. And this is a major question because this is sure. The Web3 is here, like AI, the Web3 is here to stay for a long time, and it will change the way we interact and the way we trade assets, especially on the tokenization side, how we trade assets globally. So the question I receive regarding that regularly from family offices is, we are a serious investor. I am not putting money into crypto. It's just speculation. I can understand, especially on the crypto. It depends what kind of crypto we are talking about. But if we take the facts, BlackRock launched a Bitcoin ETF last January 2024. It crossed 20 billion in assets under 60 days. This is the fastest ETF launch in history. Today, BlackRock manages over 55, 56 billion, the time we speak, 55, 56 billion under management. So I don't think BlackRock is a speculator. JP Morgan's blockchain payment platform, for example, called Kinexys, now they process over 5 billion per day in transaction volume only on their rails. I don't think JP Morgan is a speculator too. Abu Dhabi Sovereign Wealth Fund has direct digital asset exposure. Abu Dhabi is not a speculator too. The question is not, is crypto speculation? The question is, what are you waiting for that BlackRock, JP Morgan, and Eddy already saw? I'm not saying to put all your wealth or all your portfolio, 50% of your portfolio in Bitcoin. I am saying 3-5% in a structured, custodied digital asset allocation changes your return profile meaningfully and positions you for the tokenization of real-world assets, which is the next $10 trillion opportunity. So the question on Web3 and crypto, obviously, the regulation, the legal framework at the international is not clear enough right now. But I think if you want to allocate or participate to the crypto ecosystem, having a part of its portfolio in Bitcoin, Ethereum, or XRP, or any other utility token is not that bad. It really depends of what is your vision regarding the Web3 and your implication in the coming years into this industry. But this is key today to at least trying to edge the risk of the 60-40 model to start to have some digital assets in its portfolio. When the tokenized ownership will be global, I think we will start to trade tokenized stock instead of trading regular stock. So the institutions moved. The question is whether you move with them or watch from the sidelines. And this is what we say to the family office we work with. We say that I don't think you have the luxury to avoid considering this alternative asset. So I think it would be great to have a proper episode, a proper live only for this on crypto and Web3. I would love to receive some wealth manager or family offices that are directly involved into that. I would love to have them to have their opinion on that. If they have the strategy, what are their strategy, how they are selling it to their investor. That would be very interesting, and I would love to receive to do a live Q&A with an audience that can ask question live. That would be very, very interesting to try to demystify the access to Web3 and crypto in family office business. So now I want to talk about the Dubai and MENA question. We are working with a small family office in France, and the question they asked me was, why MENA region? And why Dubai specifically? Isn't just real estate and oil? This is what still people think that. Still people think that Dubai is real estate and oil, highly speculative. Obviously, what we are living right now will trigger probably a correction into the market, which is very healthy for a market like Dubai, because Dubai, since the crisis of 2008, 2009, the real estate market in Dubai is like this, never corrected. So I think, never corrected since the COVID. Obviously, the whole world corrected, but since the COVID, nothing changed a lot. So I think it's very healthy to face correction into the market. Some things very important regarding Dubai. Dubai is now ranked among the top 12 global financial centers by the Global Financial Centers Index, ahead of most European capital. It is the undisputed number one financial hub in the MENA region and the top 4 global destination for greenfield FDI capital. Zero capital gains tax, zero income tax, full foreign ownership since 2021. We don't need to associate anymore with local to build a business. Full foreign ownership since 2021. And no other jurisdiction of this scale offers that kind of combination. That's 100% sure. MENA sovereign wealth funds now manage between $5 and $6 trillion in assets. Gulf funds alone control approximately 40% of all global sovereign wealth. The capital is already here. There is no question about that. The question is whether you are positioned to access the deal flow. So now it's something that I'm saying, especially for family offices in the US, family offices in Europe. We are already in the capital of the world for the investment. The question is whether you are positioned to access the deal flow. If we speak about the real estate, Dubai property prices surged 50% since 2021, since the end of COVID, and are still in a structural growth phase, except now, since the conflict that we have with Iran and so on, this is a bit complicated. But prior to that, since 2021, we were still in a structural growth phase without correcting, with something like between almost 200,000 transactions in 2024. It was the highest in the Emirates history. So the just real estate and oil is what people said about Singapore. And look at it. Now Singapore is a $500 billion financial center. The Gulf Sovereign Wealth Fund controls 40% of all global sovereign wealth. The money is already here. So the question is, are you here? Or if you are not, find a way to be here. The other question I have from family offices is regarding the succession. And this is an important question, the next generation question. The question I receive is mainly like, my biggest concern isn't returns, it's my children. How do I make sure the wealth survives the next generation? And this is key. Me, I really love the governance model when the fund manager are coming from the family and the asset manager are people from the outside, pure professional of fund management. I love that because it's very important to bring perspective into a family office. Obviously, a lot of family offices understood that, but I think having asset manager that are coming from the ground, from the field, can really help you to curate more deals and mitigate the risk in a better way. So to come back on the succession and the next generation question and their concern about the children and how do they make sure the wealth survives the next generation, I answer that 70% of family wealth is gone by the second generation, and those are facts, and 90% by the third. This is not bad luck, big governance failure. The families that preserve wealth across generation, three things in common: a written investment policy, a formal family council, and a clear separation between ownership and management. This is what I said. Ownership and management has to be totally separated and to bring more dimension on how we drive the family office. The next generation needs to be educated, not just inherited. So I think including a part of education of the new economy in the family office, especially for the kids that are taking the lead or interested to drive the family office later, having a big part of the education, probably coming from the outside, from the experts that you can add to your board or to your training session that you may have regularly. The education for the next generation will be crucial. The heritage is not only this. When we see that the inflation, if you want to keep your money, the inflation can kill the family wealth in less than 3 generations. So education for the coming managers of those family offices will be very, very key. So the wealth without financial literacy is a countdown clock. Tokenization is actually a structural solution here. I'm a really big fan of tokenization. I studied tokenization for more than 5 years. I'm a big believer of tokenization. The main problem with tokenization, to be very efficient, my point of view, the tokenization will be very interesting when it will be fully decentralized, meaning like there won't be any border, any jurisdiction, anything that can block the trading. But the main concern that we have right now with tokenization is the source, the asset itself that we want to trade. That can be coffee, that can be oil, that can be real estate, that can be has to be regulated somewhere. So I think the big work is to do now around how we bring the certainty that the tokenized share we are trading are really the ownership or the proof of ownership of the asset, and at the same time opening the doors and opening the borders by using decentralized ecosystem for trading. I think this is the challenge for the next 5-10 years, but I'm pretty sure that we are very close to that. So if we speak about tokenization, yes, it is actually a structural solution for that. You can fractionate assets. You can create transparent governance on chain. This is what I said. When you create a governance on chain, meaning decentralized governance, you do not rely anymore on human trust because everything is clean, everything is open source, is on the blockchain, and everything is ruled by smart contract. Meaning like if everything is ruled by smart contract, you know that if the action A is not happening, the action B will never happen. And this is, I think, the key for scalability. So you can fractionate assets, create transparent governance on chain, and give each family member full visibility without giving them operational control. The question is not how much do I leave them? The question is what structure do I put around it to be sure that even if they don't want to educate themselves, they will have the structure ready to cross the generation and without saying, and if they don't want to be educated, if they don't care. Your system needs to carry the wealth. Nowadays, with the Web3 technologies, tokenization and decentralization and blockchain, you can do that for your family office. 70% of family wealth is gone by the second generation. It's not crazy and it's not bad luck. It's a governance failure. And now pushing a governance failure will be not accepting to push the governance on chain or at least integrating Web3 solution in the governance model. Then another question, we spoke about that before, but I think it's key. We speak about this now. The advisor. What are the kind of advisor you have on your board at the family office, and how you can improve that, how we can bring more clarity to your board? The problem with the advisor and banker question is I receive questions like, I have a private banker at a major institution, top banks, top private banker, working there for 40 years. He manages everything for us since several generations. Should I be worried? I don't say that you have to be worried because there is a lot of great private banker. But your private banker has a conflict of interest built into his job description. He sells products his bank manufactures. So he's a seller of the product of the bank. He gets paid on asset under management, not on your performance. So this is my main concern with private banker, because the private banker is not working for you. He's working for the bank and to get results and to get more asset under management, not on the performance of your portfolio. So obviously they have systems, they have methods that they use to be sure that you are happy enough to stay. But they are not here to maximize your chances to preserve, to scale, to grow, and to mitigate the risk with a long-term vision. Because if a private banker wants to speak about long-term vision, they will have to unveil the inefficiencies of the private banking system. But that's another topic. So the misalignment is really structural with a private banker. It's not about the individual himself. It's about the system, how it's done. So this is what I said to the family office. It's like, you just have to ask a question to your private banker to see if you can rely on him. It's like, what percentage of your personal net worth is in the same products you are recommending to me? And watch the answer. I think this is the key. The question is key, that kind of question, because you break the barrier of professional or supplier to customer, and it's much more human to human between you and me. How much did you put into that? So obviously it can lie, but you will see the reaction. And a good advisor aligns incentives. It should be co-invested, fee transparent, and able to show you 10-year track record in writing. That's what I would expect from my private banker. So no, you don't need to fire your banker. You need a second opinion. So you need to structure your board of advisor, having people coming from venture capital, from hedge fund, from the startup ecosystem, from anything. You need to bring perspective into your board, even in family offices. Now the hedge fund have a lot of startuppers and a lot of operators. They need operators because to really stick to what is possible to do and what can be the future, you need to spend time with operators, because operators are hands-on all the time in businesses, so they see the things shifting. So very important to consider to improve your board of advisor in an innovative way. The most expensive advice is the advice you never question. So you have now to question everything. I think putting everything in question right now for family offices is key to reframe, to rework, and to draw again what would be the plan for the next 50 years, taking into consideration AI, taking into consideration emerging technologies, taking into consideration the multipolarity in the world right now. So now I will talk a bit about what we are doing at Limitless Capital, but it's also related to family office, because we have that kind of feedback from family office, and now we are structuring the fund right now, and we are starting to receive some soft commitment. And I wanted to talk about that because the fund and co-investment question, especially to taking more risk, to invest more in funds, more in innovative structure like venture capital, how a family office can do that right now without losing their risk management framework. At Limitless Capital, we are building a 100 million incubator and accelerator fund focused on MENA region, Europe, and emerging markets. So we give family offices co-investment access to vetted early stage companies, deals that are not available on any public market, not on angel list, not on any platform your banker has access to. The model is simple. We source, we vet, we structure. We are totally hands-on with them. So any company or any startup we will invest in, we will have spent at least 1 year with them structuring their commercial strategy, marketing strategy, go-to-market, and fundraising strategy. Will help them to build the board and to help them to have a long-term go-to-market strategy. The minimum ticket sizes are designed for family offices, not institutions. We want long-term partners, not just capital. If you are a family office managing $20 million or more, and you want access to deal flow that your private banker will never show you, this is the conversation that we can have together. But this is another question. So it was the question that I wanted to address. Every week we will come back live with more questions. We will drop a formula where people, family offices or any kind of people will put their question in, and we will prepare the answer and answer live. Another part of the Q&A will be also answer will be a bit more structured for the live, to have to answer live, to pick some question directly in the chat live and answering on the spot. I also would love to receive some family offices, some wealth manager, to try to put things in perspective, to democratize a bit the access and what is really happening right now in the family office ecosystem, and how family offices can really take advantage of the upcoming wave by the new technologies and AI. So if you are watching this right now and you manage a family office or significant private wealth, what is the one thing you should do this week? I think you should audit your current allocation right now. You have to write it down. What percentage is in public equities? What percentage is in bonds? What percentage is in alternatives? What percentage is in real assets? If you cannot answer that question in 60 seconds, that is the problem. Or if you are missing some alternatives option in your portfolio, this is also a question you need to ask. Get a second opinion, not from your current banker only. I don't say they are bad. I say that it's very important to bring perspective to your board, but from someone with no product to sell you. I think at least that would be great. And ask one question at every meeting with the private banker. How are you compensated on this recommendation? And if you want to have that kind of conversation with me, do not hesitate to catch me on LinkedIn. I am also on all social network. I just joined Substack, which is very interesting. On LinkedIn, I'm on TikTok, I'm on Twitter. So everything will be in the replay, in the description. So to close this chapter, this Let's Talk Business Special Family Office, I would say that the families that win the next decade are not the ones with the most money. They are the ones who asked the right questions before. So I will see you next Wednesday, 8 p.m. Dubai time. The replay will be on YouTube, will be on all other platforms. And thank you very much for joining. I hope for the next one to have a lot of questions coming from you. In less than a month, we will have one very interesting family of joining us for a live Q&A question. So thank you very much for participating, and see you next time. Bye-bye.